According to the Bureau of Labor Statistics, during the month of May, non-farm payrolls in the United States grew very strongly. However, when you look at the details of this report, the growth of the labor market really doesn't look all that hot. And in particular, when you look at a lot of the details from the totality of the employment situation report, there's a lot of questions that need to be answered. And in this video, we're going to go into great detail to try to address and answer a lot of those questions. Before getting into the really granular details of this report, let's just briefly review some of the headline data. First and foremost, non-farm payrolls expanded by 272,000 total jobs, which ranks in the 53rd percentile. That's a little bit above the median historically. So it's a pretty good performance. But more importantly, it was a significant acceleration relative to the prior month, and it was a pretty significant upside surprise relative to expectations. In addition, average hourly earnings came in significantly above expectations, which is great news for the incomes of American workers, but it does raise some concerns about inflation. Now, despite the strong picture that's superficially painted by the establishment survey, the household survey in the employment situation report paints a very different picture. For example, according to the household survey, unemployment actually went up, and this number really surprised to the upside. And in addition, there's just a whole lot of other data points sprinkled in this report that really lead you to question how strong the data of the labor market really is. And we're going to get into every one of those details a little later in this report. Before diving deeply into the fundamental details of this report, let's just look briefly at the initial market reaction. Now, the 10-year Treasury yield and across the Treasury yields spiked very significantly in the aftermath of this report. And this is because the non-farm payrolls figures give the impression that the economy and the labor market is humming along very strongly. As I said, I have some serious questions about that, but that's how the market interpreted the data. As a result of Treasury yields rising and the prices of bonds falling, initially the S&P 500 also fell. However, the S&P subsequently recovered, and that sort of makes sense because there had been some concerns about a slowdown in the economy. If jobs are growing fast, it means the economy probably isn't slowing fast, and it probably means that earnings aren't slowing fast. The overall reaction makes sense if you look at things superficially. But if you look at things more deeply, there's a lot of questions that I think need to be addressed. Let's look at some of the detail in the non-farm payrolls data. As we mentioned earlier, the percent rank of the 1 month growth in total non-farm payrolls was pretty good. On a 3-month basis, we're also pretty close to average, but we're a little below average there. Another interesting thing you see here is that the growth of government sector jobs is growing a lot faster than private sector jobs, and that's never really a good thing to see. In this next section, we're going to look at the attribution analysis. In other words, what we look at here is which categories are contributing to the growth and acceleration that we saw in the previous graph. So I mentioned earlier that government jobs are growing faster than private jobs. And that here because in terms of the contribution, government jobs contributed about 33% of the overall acceleration. However, government jobs only represent 14% of payrolls. Therefore, the growth in government jobs was disproportionate relative to the growth of private jobs. Although we don't see that figure here in this chart, the biggest and most important question that's raised by this non-farm payrolls data is that 231,000 jobs out of the total of 272 from an estimate by the BLS of the net number of jobs that were created from new businesses being created minus old businesses shutting down. That's their so-called birth-death model. And their birth-death model suggests that the net number of jobs being created from this is very strong. However, when you look at a whole bunch of other data, that doesn't seem very likely. The number of new businesses being created, particularly small businesses, according to a whole bunch of other data, shows that it's really slowing down. In addition, there's been a lot of closures of small businesses. So we think that the number of jobs created through this birth-death model is going to be significantly revised downward when the BLS makes its annual adjustments. But in the meantime, it's making an extremely disproportionate contribution to the entirety of the jobs that were supposedly created in May. And I think that this really raises a lot of questions about the accuracy of the picture that the establishment report is painting. What does all this mean for the economic outlook? If you take the establishment data at face value, that the estimate of the 3-month growth rate in payrolls was actually revised up modestly as a result of the strong data this month, and despite the fact that prior month's data was revised downward. However, there's a whole number of reasons that I have whereby I question the strength that was reported in today's numbers. The first of them is simply that there was a whole slew of data that came out during the month of April that very strongly showed that the U.S. economy slowed pretty significantly during the month of April, and it has been slowing down very quickly. Now, it's always possible that this May data that we see from the BLS shows that the economy reaccelerated in May. But this is directly contradicted by the household data that actually suggests that the number of jobs in the U.S. economy actually shrunk during the month of May, and that unemployment actually rose significantly, and that labor force participation actually fell. So there's a big contradiction there, and I should point out that in general, there's been a very wide gap that's been developing between the establishment data and the household data. And this is a controversy, but I should also mention that there's been a couple of analyses by Wall Street economists and also by some Fed economists that suggest very strongly that the establishment data this year, when they do their annual revisions, is going to have to end up getting revised downward very sharply. And I am definitely of that view that the establishment report has been exaggerating the strength of the labor market. There's some other details that are interesting and that we should probably view with some concern, both from an economic point of view and that also have some political implications. One of those is that when you look at the composition of the job growth, which is that almost all of the job growth that we've had during the past year has been jobs that have been created for immigrants. Native-born jobs are new jobs for native-born Americans have actually not been doing very well at all. And that pattern was repeated this month. In addition, when you look at full-time jobs, the number of full-time jobs actually fell during the last month, and that usually doesn't happen unless you're in a recession. So it's mainly been part-time work that's picked up, but full-time work has actually gone down, and that's never a great thing. Another interesting fact is that it seems that multiple job holders has risen very significantly and has reached new highs during this past month. That also suggests that the economy is under some stress. Why are so many people having to work 2 jobs? It's an interesting question. So overall, this report, when you look at the totality of it, both the establishment survey and the household survey, is sending mixed signals regarding the strength of the U.S. labor market. By contrast, there isn't really any ambiguity or doubt about the fact that inflation actually accelerated in the past 3 months. So I think that overall, when the Fed is going to be looking at this data, they're going to be saying, you know what, there's some mixed signals here about exactly how strong the labor market is. There isn't much doubt about the problem we have with inflation. And so what that adds up to is that the Fed is probably going to hold off on cutting rates until it can get some more clarity, particularly about what's happening with the growth of the economy. So let's turn briefly and review how all this affects the market outlook. First thing we have to say here is that unfortunately this hopeful news for workers that we got from the non-farm payrolls data is worrisome news for markets, because what it means is that it makes it less likely that the Fed is going to cut rates, and the market has been really hoping that the Fed is going to come in and cut rates. So that is definitely one factor that's going to be affecting the market outlook, which is that this strong jobs number is going to muddy up the picture for the Fed and make it a little bit less likely that they're going to actually cut rates to try to save the economy from any kind of deceleration. The other thing that I think that we can perhaps surmise from this is that because the fundamental outlook for the economy is so uncertain right now, there's quite a few contradictory signals. There's a lot of doubt about exactly what the Fed is going to do and what financial conditions are going to be. That sort of leaves the door open for the market to be dominated by technical factors. In other words, when there isn't any clarity about the fundamental macro picture, it's really technical and behavioral factors that take over. And that's something that we're actually seeing right now. For example, just today, usually the non-farm payrolls report, the employment situation report, is the most important event in the market. But instead, the most important event in the market today by far was the live stream by Roaring Kitty on his position and his view of what's going on with GameStop. So that kind of tells you right there that there's other things that are a priority right now, simply because we don't actually know, or the market doesn't have a good feel for what the macro fundamentals are doing. Let's wrap up this video with a few concluding thoughts. The first thought I want to leave you with is that macro uncertainty is rising. There's a lack of clarity right now regarding the strength of the U.S. economy. During the first quarter of this year, the economy grew a lot stronger than almost anybody expected. And the whole problem that we seemed to be having was that the economy was growing a little too fast. But then all of a sudden in April, we have this very, very pronounced deceleration in growth. And it looks like the economy may have potentially even contracted in April. So that sets up a very strange situation of where are we in May? And already in May, we're starting to get some contradictory data. We got a weak manufacturing purchasing managers survey, but then we got some pretty decent service sector purchasing managers surveys. In this employment situation report, we got some really strong data coming out of the establishment report, but we got extremely weak data coming out of the household report. So there's a lot of contradictions here, and I think this is building up a lot of uncertainty about exactly how strong the U.S. economy is right now. The other thing that I want you to take from the analysis today in my video is that there's a lot of questions that we need to be wary of right now about the quality of the data that we're getting from the BLS at the moment. Now, I want to be clear that I don't think that, unlike other people, I don't think there's any sort of conspiracy going on, or that there is some sort of intention on the part of the BLS or by the government to deceive the American people. I think that the problems that the BLS are having right now are just in the nature of what they're doing. The system of collecting data that they have is prone to error. And that's just a fact that we have to deal with. And that's why we don't look at just one indicator. We look at a variety of indicators to have a system of checks and balances where we're able to look at a broad array of indicators to see how strong the economy is. But when we look specifically at the labor market, there's a whole bunch of labor market data that seem to contradict one another. And that is definitely the case when we look at this divergence that's emerged between the establishment survey data and the household survey data. And in addition, there's a bunch of other data, by the way, that measures the strength of the labor market that in general have been pointing to the idea that the labor market is actually decelerating. The other thing that I think that we need to look at here and question is what's the quality of U.S. economic growth? What do I mean by the quality of growth? When economic growth is growing because the productivity of the economy is growing, when people where production per worker per hour is growing, that's quality growth. But if you're getting growth simply by adding new workers and new consumers into the economy, that's not necessarily high quality growth. That kind of growth also produces certain other problems that can exacerbate inequality, because the influx of illegal immigrants into the United States is disproportionately affecting a certain segment of our population. And that segment of the population is struggling, and the wages in those particular sectors of the economy have stagnated and aren't doing particularly well. And at a time when inflation is very high, the fact that wages are stagnating in certain sectors of the economy means that a lot of people are really hurting right now. And that's an issue that is both important economically, and it's also going to have some importance politically. The other thing I want to just talk about briefly here is that the number one macro risk that the U.S. faces right now is that we get an oil price shock. And in a whole bunch of videos that I really encourage you to watch, I have been talking about the fact that the U.S. economy is particularly vulnerable right now to an oil price shock. Why is that? Because right now it really does seem that the U.S. economy has slowed down very significantly. And right as the U.S. economy seems to be stalling, if we were to get an oil price shock that caused inflation to rise, that caused interest rates to rise, that caused financial conditions to tighten, that would also handcuff the Fed in its ability to cut rates, that all those things would really put us in danger of pushing the economy over into a recession. I really encourage all of you to look at some of my videos on the risk of an oil shock and why I think that the U.S. is particularly vulnerable to that during the second half of 2024. All right, so thank you for watching this video. I encourage all of you to subscribe. I'm going to be posting a whole bunch of videos on some really interesting topics in the next few days, and I encourage you to subscribe so you can watch those videos. Thank you.